Ranges are one of the key fundamental concepts in trading technical analysis itself. I've made over 90% win rate trading it for the past month, and I want to show you guys how I do it. So let's get into it. I want to get you guys familiar with the terminology here. We've got 3 levels to look out for in a range, and this is what defines a range basically. This level on top here is basically called our range high or our supply area or supply. You have multiple terminologies of this. This could be a resistance, again, supply for example, but the main idea here is that whenever price reaches into levels or areas near this level, it has a very high probability of rejecting. Same goes for the range bottom or the range low. This is our demand or support level, and this is where the most buyers will step in, or where we can anticipate a surge of buyers, coming into the market and pushing prices up, therefore reversing it from the downturn. The next level I want to talk about is a level called the mid-range. This level is basically can be treated as support or resistance based on the momentum of that specific swing. For example, if it's going up, this could act as support. If not, if it's going down, then it could act as potential resistance when it goes down. But yes, going over it, the playbook on how to start trading within the range is very simple, and it goes something along the lines of this. The rule set that you want to follow is whenever it's near range highs, you're going to expect it dropping. Whenever it's near range lows, you're going to expect it going up. Now, this is simply a probability driven setup, since you know that the odds of prices rejecting near the highs and then bouncing off of the lows are very high. You can make bets or trades, in this case, betting that prices will chase that higher probability outcome that you already know is going to happen. And this is based on years and years of research. This is something that's already based in the traditional markets themselves. Supply and demand is a very known concept, and this is just how price works. This is where constantly trying to find that equilibrium and that fair price. I don't want to get into how the price action and how it delivers and stuff like that. I want to explain how you can squeeze as much money as out of the markets as you can using a strategy like this. So whenever markets are ranging, the best kind of play style you can have is what I'm going to explain right now. And whenever we have very volatile, swinging moves, there are different plays that we will get into from other videos. So starting off, as I said, range highs will be your higher probability rejections, and then the range lows will be your bounces. How you can play that obviously is by going into shorts whenever we're in that range high level or range or area, and then whenever we're near the lows, you're going to want to go for buys or long. There is a very specific trade style that I use to get specific levels of validation and have high risk reward trades, so I can get really good yields out of the trades. And I use something else called a deviation to give me my levels. Now, let me show you what a deviation looks like. Whenever we're in this range and we attempt going out of it and then come right back into it, that creates a deviation. Here, I'm going to mark, if you can spot the range on this chart right here, the deviation on this chart. It is very, very simple to see, but you can kind of see it right here. Kind of see price went all the way down here and then picked up right where it left off, and then we ended up going higher. Now, after a deviation, obviously the next pivot or level that price is going to get attracted to is the next opposite level. So if we just peaked from this range low, the next level that it's going to be targeting is the range high. How that kind of works is, and how you can trade it, is basically whenever we get a range reclaim or we confirm this deviation, so we enter the range, we close a candle for in the actual charts, we have to close a candle above this level to confirm that. Whenever we do that, you can safely go in with a long. Your target obviously is going to be the range high right here, and for stop losses, there is a very simple thing. Just go for the previous pivotal low or that previous deviation. So if we had other deviations here, for example, you should ignore those, and this last one should be your because this is more often than not the most accurate invalidation level. And why I say invalidation level is because if price were to go even lower and break this down here, this would mean that this range is broken and we are shifting into a downtrend, right? Because we have just created a lower low. As long as price stays, stay stable, your target is going to be this, and this is the kind of trade that you want to approach. Now, the exact same thing can be done flipped over. So if I just invert this, you can kind of see how it looks like whenever it's on the flip side. So we have a deviation on the upside. We tried to break it, but then we came right back to where we were, and then boom, you enter with a trade, stop loss right above there, and then you go for a target right down here, and then you get a nice 2.0 2.8 risk reward trade. Depending on these deviations and how volatile prices are, how the deviation gets formed, if you get big one or a small one, for example, sometimes you get deviations like very tight like this, and you can get extreme risk reward ratios. In most cases, the average one that I found from my previous backtesting and trading is around that 4 to 5 risk reward, which is, for any trader that is hearing me out here, a very nice amount. And we can all agree that those are trades worth chasing. And in our case, you can kind of see the appeal to this because there are, you can trade things both ways. You don't have to wait to be one directional. You don't have to have a bias. Yeah, these are ranges, by the way, can also be found in multiple time frames. So the higher the time frame, the more accurate it's going to be, but the longer time it's going to take to get a move out of this. So if you're trading on a 1 hour like we are right now, for example, it's going to take maybe a couple days to get from one pivot to the other. But when you're trading the daily range, which is often the highest time frame range that you should care about, you're going to be waiting even months or maybe a year, for example, to get a pivot from one side of the range other. You can kind of understand what I'm saying here. What I want to tell you guys is that whenever markets are in a bad condition and they're not, proving to have very high volatility, they're just consolidating in a tight period, this is how you can still keep trading and still find setups even though nothing's really moving with the direction and is just staying where it's at. Whenever we're in a low volatility period, you can go for a setup like this, find that range high, range low, and then you can potentially find setups like these. So this is the both sides trade. We have a top range right here, or a range high, and then a range low down here. You can kind of see that it acted as support multiple times. You could have bought here, sold here, and then bought here. So shorted, longed, shorted. You can kind of see what I'm talking about here. Going back though, if you were looking for that deviation that I'm telling you about, boom, right here, we got that deviation. We just reclaimed right into this range. You could have went long right here. Stops right below here, and then target is right above. So range high or near the pivotal range high, so that previous swing that you've got. And then over time, let's see, you'd have gotten the full take profit of the trade. And if you waited just a little bit more, you didn't trim all your profits, you could have gone and had a very nice trade. So 12% spot, a very nice trade. But as I said, you could find setups a lot more frequently if you just didn't look for these deviations specifically and just traded the levels. So longed on the bottoms and then shorted the tops. Same things could be done. So you could have longed here and then shorted here, for example. But the only thing that's wrong with that is that these invalidation levels become very hazy, because if you don't really have any deviations to go off of, you do not know where to place your stop losses. And more often than not, traders place their stop losses very close to market price or their entry price, and they end up getting stopped out, causing them to lose money. This setup has been backtested by me personally and by multiple people, because this is a very popular strategy, very popular concept. It's not something that takes a very advanced trader to do. I think most traders can do this even if you don't have a lot of experience. If you just know how to use TradingView or any charting software for that matter, just know how to draw lines. And even for that, if you want to automate that, there's a tool on TradingView called the fixed range volume profile. I had it favorited right here, but you can find it right above here. So look to the projection tab right near the volume based indicators, the fixed range volume profile, and then wherever you kind of expect to see a range, you do that, you mark it out just like so. You can even stretch it even further, so however long you want to see, like this for example, and then boom. What this is going to give you, it's going to give you a very clear picture of range or two levels that you can follow, and these are entirely volume based. So where the price action has been printed, this is the most active area. This is very easy to use if you're a beginner, for example, and you don't know how to read or find levels yourself. This is something that you can use. It can give you very accurate levels. Obviously, as I said, the higher the time frame, the more accurate you can be. But this, I've seen it work on the 1 hour. Like, let's say you build a range on the 1 hour, and then you can go on the 15-minute and then start trading off of that. Right now, we're kind of having that weird price action, as you can kind of see. If you can kind of check out these candles right here, you can see that there are very, very small, not a lot of volatility. That means that there aren't a lot of on-chain catalysts or news for people to go and buy or sell Bitcoin, which causes inactivity from buyers or sellers. sellers and it causes us to stay in areas like these. So this is pretty much untradeable what we're doing right now. This is obviously, we're in a Saturday, so we can expect lower volatility, but as you can kind of see, this has been a trend throughout the week. Normal markets should be very volatile, like this for example, and should have an easier time trading. But whenever you find yourself stuck in a range like this, that's the kind of playbook you should follow. For more trades and my personal insights, you should come over to Surge. I post all of my actual material. We host weekly live streams where I go over the market and explain what levels to watch out for, and I'm hoping I see you guys there. Bye bye.